Imagine two Americans. They live in the same city, shop at the same grocery store, fill up at the same gas station. Both got a raise this year. Neither lost their job. Neither experienced a financial emergency. By every normal measure, both should be doing better. But one of them quietly stopped eating out, started driving less, delayed a dentist appointment, and quietly removed buying a house from their 5-year plan. Not because they made bad decisions, because the economy changed without looking like it changed. That's the strange thing about economic crises. The dangerous ones don't always arrive with collapsing banks or stock market crashes. Sometimes they arrive with perfectly normal headlines. Inflation is cooling, jobs remain strong, the economy beats expectations. Everything sounds fine, yet millions of Americans are asking the exact same question. If everything is supposedly getting better, why does my life still feel more That's the mystery. Because this isn't a recession announces itself. People lose jobs, businesses fail, markets panic, news channels run countdown graphics. Everyone knows something is wrong. This is different. Nothing seems broken. Yet somehow, the finish line keeps moving farther away. You earn more, but save less. You work harder, but feel further behind. You cut unnecessary spending, yet your bank account barely notices. It's almost as if someone quietly changed the rules of the game without telling anyone. And that's exactly what's happening. Not through one dramatic event, but through hundreds of tiny economic shifts that most people never notice individually. Because here's the uncomfortable truth. The biggest threat to your financial future isn't always losing your income. Sometimes, it's slowly losing what that income can actually buy. That's a completely different problem, and it's far more dangerous. Because you don't panic, you adapt. You skip one vacation, cook at home a little more, delay replacing your car, ignore that strange noise your washing machine started making. None of those choices feel life-changing, but together, they quietly redefine your standard of living. That's why today's story isn't about inflation. It isn't about recessions. It isn't even about prices. It's about something almost invisible. A silent crisis that can make millions of working Americans poorer, even while the economy looks perfectly healthy. And once you see how it works, you'll start noticing it everywhere. Think about the last time you walked into a grocery store. Nothing looked dramatically different. The lights were on, the shelves were full, people were shopping like any other Tuesday. And yet, you probably hesitated before putting at least one item into your cart. Not because you suddenly stopped wanting it, but because somewhere in the back of your mind, your brain quietly asked, is it really worth that price? That tiny moment is the silent crisis in action. Because most economic changes don't begin on Wall Street. They begin in moments exactly like that. One decision, one compromise, one purchase you don't make. Now multiply that decision by 340 million Americans. Suddenly, it isn't just a personal choice, it's an economic force. Here's what most people miss. When inflation slows down, prices don't go back to where they were. They simply stop rising as quickly. Imagine climbing a mountain. Walking slower doesn't mean you're walking downhill. You're still climbing. That's exactly how prices work. If inflation falls from 8% to 3%, the headlines celebrate, markets cheer, politicians congratulate themselves. But your grocery bill doesn't magically shrink. Your rent doesn't rewind. Your insurance company doesn't send you a refund. Those higher prices become the new normal, and your paycheck has to catch up. Sometimes it does. Sometimes it never fully does. That's where purchasing power quietly disappears. Not overnight, 1 percentage point at a time. Imagine getting a 3% raise. At first, it feels like progress, until your rent increases by 5%. Your health insurance goes up. Your electricity bill gets a little higher. Your car insurance quietly renews at a higher premium. Streaming services become slightly more expensive. Even your morning coffee costs a little more. None of those increases seem shocking on their own, but together, they begin competing against your raise. Eventually, your raise isn't creating new opportunities, it's simply helping you stay where you already were. You're running faster just to stand still. That's one of the biggest financial illusions in America today. People think earning more automatically means becoming wealthier. Not necessarily. Real wealth isn't measured by the number on your paycheck. It's measured by what that paycheck can actually buy. And lately, that's been quietly changing. Now here's where things become even more interesting. Most Americans compare today's prices with last year's prices. Very few compare today's lifestyle with the lifestyle they expected to have 5 years ago. That's where the silent crisis reveals itself. 5 years ago, maybe buying a home felt realistic. Now it feels like something you'll think about next year. 5 years ago, saving for retirement felt manageable. Now every unexpected expense resets the plan. 5 years ago, a family vacation required planning. Today, it requires financial strategy. Notice something? Nobody officially took these things away. They simply became harder to reach. That's why this crisis feels so confusing. There's no single moment you can point to. No dramatic headline, no bank collapse, no nationwide panic, just thousands of ordinary Americans quietly lowering expectations. And perhaps the most dangerous part is how quickly human beings adapt. After a while, the smaller grocery cart feels normal. The postponed vacation feels responsible. The delayed home purchase feels practical. The tighter monthly budget becomes routine. You stop noticing what changed because you adjusted to it. But the economy notices because when millions of people all begin making smaller decisions, those small decisions don't stay small. They start changing businesses, communities, investment, hiring, and eventually the direction of the entire economy, which raises an even bigger question. If millions of Americans are quietly buying less without a recession, what happens next? Here's the strange part. If you ask 10 Americans whether they're in a financial crisis, many will probably say no. They still have jobs. Their paychecks still arrive every 2 weeks. The grocery stores are full. The lights are on. Life goes on. And that's exactly why this story is so easy to miss, because the biggest economic shifts rarely happen in one dramatic moment. They happen through thousands of ordinary decisions that slowly reshape an entire country. Let's imagine something. Picture two versions of America. In the first, families go out for dinner twice a week. They replace old appliances before they break. They take vacations. They renovate their homes. They start small businesses. They feel comfortable taking financial risks. Money moves. Businesses hire. Communities grow. Now picture the second America. The restaurants are still open, but they're a little quieter. Families decide to cook at home. The vacation gets postponed. The washing machine keeps making that strange noise, but nobody replaces it. A couple decides to wait another year before having a child. A college graduate keeps living with their parents. A small business owner delays opening a second location. Nothing looks like a crisis, but almost everyone is quietly pressing the pause button. And when millions of people press pause at the same time, the economy begins slowing without anyone calling it a recession. That's what makes this crisis so unusual. It doesn't destroy demand. It slowly weakens confidence, because confidence is what turns income into spending, spending into business revenue into hiring, and hiring into economic growth. Break confidence and the entire system becomes more cautious, one decision at a time. Think about how often you've heard someone say, "I'm waiting. I'm waiting for mortgage rates to fall. I'm waiting for prices to come down. I'm waiting until things feel normal again." That word, waiting, has become one of the most powerful economic forces in America. Because while households are waiting, businesses are waiting too. Companies delay hiring, factories delay expansion, developers delay construction, investors become more selective, banks approve fewer loans. Nobody stops moving. Everyone simply moves more carefully, and that's enough to change the direction of an entire economy. Here's the irony. The official data might still describe the economy as healthy. GDP can continue growing. The unemployment rate can remain relatively low. Corporate profits can surprise investors. The stock market can even reach new highs. But statistics measure averages. People live individual lives. The stock market doesn't pay your grocery bill. GDP doesn't lower your rent. A record-breaking market doesn't automatically make housing affordable. Those are completely different realities. Perhaps that's the lesson hidden underneath all of this. A strong economy doesn't always feel like a strong financial life, because your quality of life is determined by headlines. It's determined by choices. Can you afford to save? Can you afford to buy a home? Can you replace a broken car without panic? Can you take time off without falling behind? Can you plan 5 years into the future with confidence? Those questions reveal something no inflation report ever can: the real health of everyday Americans. So, is America facing a silent crisis? Maybe that's the wrong question. A better question is this: If millions of hardworking people are earning more than ever, yet feel less financially secure than they did just a few years ago, what exactly are we measuring when we say the economy? Because until those two stories begin to match, the silent crisis won't feel over, even if nobody ever officially